With permission of the chair and discussant, may we please begin the session?
Yes, please.
Thank you. Good morning, ladies and gentlemen. I am Shruti Shukla, student of PGDM Securities Markets at NISM, and I'd like to extend a very warm welcome to our chair, discussant, and all attendees and paper presenters here. Welcome to session 4B on evolving market landscape. Before we begin the session, please allow me to walk you through the guidelines. A total of 15 minutes will be allotted for paper presentation, upon completion of which a bell will be rung. Post this, 2 minutes will be allotted for presenters to conclude. This will be followed by 7 to 8 minutes of discussant remarks with an additional 5-minute slot for questions and answers. To introduce our chair and discussant, Dr. Shunmugam is currently the head of Commodities Education Cell at NISM. Prior to NISM, Dr. Shunmugam worked at various institutions such as Multi-Commodity Exchange of India Limited, Nomura Research Institute, Financial Technologies India Limited, Metropolitan Stock Exchange of India Limited, United States Department of Agriculture, developing his expertise in commodities markets, currency derivatives, debt markets, international trade, and policy advocacy. He has about 25 years of accomplished unique professional experience encompassing diverse areas of commodities, debt, and currency markets, financial services consultancy, risk advisory, treasury risk management, and international commodity trade. His expansive skill sets includes setting up of risk management framework, policy advocacy, thought leadership, electronic surveillance mechanisms, development of index products, and development of business verticals in financial markets and exchange services. Welcome, sir. Our discussant, Mr. Narsimhulu Siddula, is an assistant professor at NISM. He is the recipient of the Indian Council of Social Science Research, doctoral research fellow from Institute of Public Enterprise, Hyderabad. And before joining NISM, he has worked as an assistant professor in the Department of Finance and Accounting at IBS, Hyderabad, a constituent of the ICFAI Foundation for Higher Education, Hyderabad. He has had 15 years of teaching and research experience and teaches financial reporting and analysis, corporate finance, securities analysis and equity valuation, and foreign exchange, markets, and international finance. His research interests are commodity derivatives, capital markets, asset pricing, and risk management. With permission of the chair and the discussant, we'd like to begin the session. So I'm handing it over to you to take the session forward. Thank you.
Nikhil is there? Yes. Come on.
Good morning, everyone. I'm Nikhil Srivastava from Kuen University. And first of all, thanks to all of you for attending this presentation. The title of this paper has been changed in the program schedule, brochure. It is mentioned effects of financial market development on bank deposits. But I have been thinking of what should be the better title. So I have changed this financial system architecture and bank deposits. And trust me, there's no change in the paper. So
anyway, since you have told this, we will still be giving you your certificate with the old title.
That's perfectly fine.
There will be no change in that.
That's okay. That's perfectly fine. And this is my second essay of my thesis, co-authored with Professor David Tripe and Kuen. And we also collaborated with Mamiza. She is now 30 University, alias she was with the University of Queensland. So financial system architecture and bank deposits. So the first question comes in our mind, why should we care about the bank deposits? Why bank deposits? To answer this question, I would like to take you to the history of a banking system. Around 1940s and 50s, banks had abundance of funds. Their main sources of funding were equity capital and retail deposits. So most of the households used to save their money in a bank. That has got changed during 1960s and 70s. Once the corporates started coming up with the new instruments such as commercial papers and other instruments, corporate bonds, and they were offering a higher yield. So then banks started facing a problem in attracting a household's deposit. So what they did, they started offering a new types of instrument, which is known as a negotiable certificate of deposits and broker deposits. And these deposits are we consider as a wholesale funding. That's the beginning of a wholesale funding era. And we all know that wholesale funding is a rate sensitive, and it is very difficult to get the fund during a turbulent time period. And we have seen the impact of the wholesale funding during our global financial crisis. So after global financial crisis, the regulators, economists, and academicians started believing in bank deposits because bank deposits are sticky in nature. So they came up with the new norms like a Basel III norms with the liquidity coverage ratio and net stable funding ratio, giving a less runoff factor to the different maturities and retail deposits. So bank deposits are important. Now coming back to this financial system architecture, in general, we find that there are two types of a financial system. One is a market-based system, and another one is a bank-based system. The financial US and UK are the representatives of financial market-based system, whereas Germany and Japan are representatives of a bank-based system. So do bank-based system or market-based financial structure lead to different outcomes in terms of deposit stability? This is the question the answer of this question I'm seeking for. So coming back to this literature review, there are n number of research papers related to highlighting the importance of financial market-based system and a bank-based system. There are economists who believe that financial markets is better in disseminating the information and improving the corporate governance and capital allocation. Some of the economists believe that the banking system is good in terms of acquiring information related to firms and managers and capital allocation, which lead to economic growth. There are papers, there's one paper of Boot and Tucker. They studied what they found actually, that there are different types of customers who target these institutions differently. For example, new borrowers and startup companies go to a bank to get the funding, whereas reputed firms go to a public and raise their funds from there. Now, in general, in every country, we almost like we have a stock market as well as the banks. So what is the relationship between them? That study has been done by Song and Tucker, a very seminal paper in 2010 published in the Economic Journal. They found that there are two types of relationship. One is a competition, another one is a co-evolution and complementary. So in a fragmented market where the financial markets and financial system is not very well developed, these two systems compete with each other. Whereas when the financial market is very developed, financial system is developed, they co-evolve and co-integrate. Now, however, this study is actually from a bank's lending perspective, and this is a theoretical paper. On the other hand, in my paper, I'm looking at this paper from a borrowings perspective. And also, this is an empirical study. This is just a graph to show you that why this study is very important. We can see that stock to GDP ratio has gone down significantly after the global financial crisis. So you can see that there is some change in behavior in using the financial market and financial system altogether. So the questions remain: the competition or what? What is the relationship? Is there anything else? To identify this, I have developed a few two hypotheses for this research objective. The financial market development creates a competition between the financial market and banking system for deposits. And the hypothesis 2, the intensity of competition between the financial markets and the banking system would be greater in highly financially developed economies than less financially developed countries. Why? Because we have a smaller proportion to target. If it is very well developed, financial inclusion there. I have collected data from BankScope covering 88 countries, covering the period from 2004 to 2014. Sorry, I did not mention here. And IMF database for the financial market index, and for macroeconomic variables, I have relied on the World Bank's website. The 88 countries are representatives of these regions and different income strata. This is a descriptive statistics. If I can just show you one thing, I will give you the detail of what is the variable here in the next slide. I just like to mention here that time deposit proportion here, it is showing 100%, which we can say that how can it be possible? So I removed that those countries and run the regression, still my results hold. This is a descriptive definitions of my variables. So I have used 3 dependent variables. One is deposit funding, retail deposit funding, and deposit mix. Retail deposit funding is basically retail deposit proportion, and time deposit mix is a time deposit proportion. So deposit funding is nothing but the total deposit to total assets, whereas a retail deposit is a total customer deposit to total deposits, and time deposit is a total customer time deposit to total customer deposits. So this is the proportion. Financial market index, I have used the financial market index, financial market access, and the subset indices of that, financial market access index, financial market depth index, and financial market efficiency index. In general, financial market development papers, people generally use a stock market to GDP ratio and market capitalization to GDP ratio. I avoided that mainly for 2 reasons. One, the data availability, and another one is that stock market to GDP and market capitalization to GDP only covers the equity market. On the other hand, these indices actually covers not only this equity market, but also the debt market. So it gives a broader picture. And I have also used some governance indicators as a control variable.
So what is the source of the index?
Source, it is available on IMF database. Sir.
Okay. They publish it every year.
Yes, sir. Suri Zenka, she was who actually published that paper in 2016, I suppose. So they come up with this the whole index.
Whole index series of numbers.
Series number, yes, sir. So I think it starts from 95. So it gives a full range of data. So.
Data for every year, one.
Yes.
And it is currently updated up to which year?
Ma'am, I could not check it that, but I think it was.
It must be there till 2020.
2020, yes. So it is a very, it is now well cited. This is my empirical research. So earlier I was using a GMM model, but now I changed that with this panel fixed effects and using the GMM as a robustness test. So that is there. But my dependent variable are the same: deposit funding, retail deposit, and deposit mix. And I have some bank level variables, control variables, and also the country level control variable. I am using a 2SLS method mainly because panel fixed effects addresses most of the issues, but omitted variable bias, I am using a 2SLS. One of the biggest problem with the 2SLS is finding a right instrument. And I am not exception for this. I am also facing the same problems. So I have used the lag of this, my key indicators as an instrument for this. Coming back to this, my result section. So my first 4 columns are for representing the results for the deposit funding. Then next 4 columns for the retail deposit proportion, and the last 4 columns for the time deposit proportion. This is for the entire country, all countries. So we can see easily here that if I just target my key indicators, we can see there is a negative relationship between the financial market index and deposit funding using the financial market index and financial market efficiency index. The same relationship we found in a retail deposit proportion. There's a negative relationship between financial market depth index and the retail deposit proportion, which means as the financial market grows, it is difficult for the banks to get a funding. But interestingly, we find that there's a positive relationship between our time deposit proportion and the financial market. What does it mean here? I mean, my hypothesis is actually once the financial market starts growing, people become yield seeker. And that's where they go for even for time deposits. And we can see because retail deposit proportion not only includes the demand deposit and saving accounts, but also the time deposits. Therefore, we can see there is a decrease in a retail deposit, but a positive impact on a time deposit proportion, mainly because of the yield seeking behavior. Now, this is for the 88 countries. And I have used the country fixed effects and the year effects in all the regressions. This is for 88 countries. But these countries are very much different from one to each other, coming from the different income level, different financial development level. So what is the impact of that? To understand this, I have divided gone through with the subgroup analysis. I have divided the whole data set into high financially developed economies and less financially developed economies. And interestingly, what I find here that there's a positive relationship between the retail deposit proportion and the financial market developed indices, and also the positive relationship with the time deposit proportion. So in a financially market developed economy, that once the financial market develops, the bank also get more and more funding. And what about the less financially developed economies? We found a negative relationship between the financial market indices with the deposit funding and retail deposit proportion. We do not find any significant relationship over here with the time deposit proportion. So we can easily see that actually the findings of Song and Tucker prevails here. As in a high financially developed economies, there's a positive relationship. In a less financially developed economies, there's a negative relationship between them. So can we conclude here that actually in a less financially developed economy, these two systems, because of the fragmentation, compete with each other. On the other hand, in a high financially developed economies, they coexist and co-evolve with each other. So one of the main reasons are actually for even banks get funding from the financial markets as a source of a capital. And once you deposit your fund to any broker account, you also need to deposit your money in the banks, and that's where you can transfer that money. So that's how actually it goes on. I have done several robustness tests because my period covers the crisis period. So I have used the dummy variables for crisis period, and my results holds there. Deposit insurance, I have used the regional study I have done. And I have also used this word governance indicators to see if there is any impact. My results are driven because of these indicators, these reasons. I have also used the GMM method for my robustness test. This leads to my conclusion. To the best of my knowledge, this is one of the few studies who talks about the financial system architecture. And my results find that there is a relationship between the financial market development and banking system. In developing countries, it is a competition. They compete. On the other hand, in the developed economies, they complement each other. This paper has a few some policy implication, as it suggests that regulators should not only focus on isolation, they should focus on integration of these two systems. That's where by doing this, banks will not only able to attract bank deposits, but also it will help them to comply for the Basel III norms. by attracting more deposits. I did not mention earlier that actually we found a negative relationship between a capital and a deposit funding. And this result is very much aligned with the findings of RPing 2019 paper of JCF, which suggests that actually as the capital grows, it crowds out deposit. So it creates some sort of a moral hazard issue. When we see that Basel and regulators generally come with the idea of increasing the capital regulation adequacy norms, we should think about that. It will also crowd out that big bank deposit. So on the other one hand, it increases the stability, but on the other hand, it decreases the stability. So we should have some balance over there. So this is all from my side. Thank you. Questions, please.
I think let him discuss it. And
Yes. Also, okay.
Just remain. Usually they are there. It is just remain.
Yeah, good morning to all. First of all, congratulate the authors by taking up the relevant, the topic with respect to the various countries that you have covered, almost 88 countries that you have covered. So paper is nicely written and organized and well structured and analyzed very well by the authors with respect to the objectives and the methodology which you have taken. And these are my observations. That is actually while reading the paper I came across. The review of literature, basically, as you said, actually your review of literature is consigned to up to 2017 in your overall papers and even including references. Okay, this is the study period is missing, 2017 to 2021. If some of the papers if you have come across in line with the topics that you have taken, maybe included this I come across. This is the one, the book which is published by Elsevier, Macmillan Publications, with respect to the financial markets, which covers the financial markets as well as the banking developments across the various countries in the world level. So it is a mix of all the research papers, which you get around 20 papers in that, right? And you may review this, actually read the papers as well as if it is relevant, and you may include. Sure. This is, and it is clearly identified the research gap and objective also well defined with respect to your hypothesis which you frame. Okay, to identify the effects of financial market development on the banking system with regard to their deposit activities, and hypothesis clearly mentioned about the two hypotheses. I want to know a simple, what is the reason behind keeping your biased enough in quoting the hypothesis? Basically, since you have studied event study and covering all the countries, almost 88 countries after screening the process by out of 192 countries which you have taken as a samples. So why you are biased instead of neutral, being a researcher? That is my concern.
Because of the theory background, that's how we perceive that there is always a competition between, once the financial market will grow, that deposits are actually going down. So that's the perception which we carry. So that's the biasness, I would say. Okay, and that is what I am saying. So very profound.
Yeah. And sample selection is too large. I think after crossing 193 countries database that we have taken, it's a very good representation. And data recency, that is what one more concern. Actually, you collected the data from 2004 to 2015, which is from this Bankscope database.
Yes.
Okay. What is the rationale behind this, selecting the data? Only
After that, when Bankscope data was not available.
Availability.
Yeah, so that's the reason. And 2004, before that, there was a problem with the properly data was not available. So that's the reason. If I had to go back, then I had to drop the country. So I thought, okay, 2004 is still giving me a good number of periods. So that's.
But I think a lot of activity in the developing markets has happened
after
from
2015,
right? Including digital
Yes.
and things like that.
So true.
So I think there will be a big difference to your results maybe in case you include the
That's a good
latest.
paper for the second
paper.
Yeah.
Yeah, that could be in the new age developments.
Yeah, new age development. That's
Because
a good idea.
utility, as Ma'am has rightly put it out, the utility may not be, maybe utility could be limited.
Yeah.
Because always we all, like supposing you are on the other side, you
Yes,
prefer what listens, listen because you're included.
True.
Because that is what our learning is.
Exactly.
That is why how we are different and what we are bringing to the table.
True. So yeah.
The research methodology is well defined, which you have taken from this broad-based index of financial development constructed by Tatiana Srivastava, 2016, which is published and available in IMF website still.
Yes.
And you can draw the data from that with the indices. And also you use the two steps GMS model to test the robustness. Okay. And these are actually the concerns which help you to go for further research. That is the events and crises that have taken place in the financial markets, especially after 2015. Some developments happened in the front of banking system as well as the financial market system, both. That is like fintech, especially. So, and global financial crisis also been covered. That is a good thing that actually you have covered this event. But even scope for further research like recent developments in fintech area, especially that actually shaped the way of the banking system at the same time the financial market front also. And also the COVID impact, that these are the areas where you can work for further research papers, 1 or 2 you may.
Good for the future research.
Yes.
Definitely, you have got work to do.
Yeah.
Thank you. This is from my.
Yeah. Can I get this PPT? Yeah.
We will share.
Yes.
Really good effort.
So it was a wonderful effort actually. So I think just adding to Dr. Siddula's comments actually. So I feel that one of the assumptions that you make, I mean you orally made it but not put it in the paper actually. Bank deposits are sticky, and it's not the case now actually because of the development of information technology. I mean the indices, the rates for corporate bonds, the returns from the yields from the debt markets, everything is known to the investors. So only thing is the access. The access is also developing because of the development in the financial. So especially this time, which is where central banks were holding the rates, have proven that retail may fly out to some other asset classes other than this if you keep the rates at a particular pace actually. So that is one. So which has been proven wrong even in a country like India because of the developments in financial technology and role of information technology in reaching out to the people. So I think what the other thing that I thought maybe you should have looked at the nuances of the level of development of the countries. Actually. So there is one set of countries such as Korea, China, and things like that. There is another set of countries which are least developed countries. So, if you have followed that World Bank's methodology, it would have been, how it's been classified to actually group them up and then analyze those by groups. Okay. Second and third, you've not shown the R square for the numbers, which is for the groups. which you have analyzed actually. And fourth was your R square in the overall model itself is very low. It's 0.2, 20%, 21% or something. Is it to show that you could add more valuables into it? Suppose in case, so I think you must have followed the previous papers, right? I mean, I appreciate the effort that you've done because I have not seen any paper. I'm from the industry. I'm getting into the academics, but I've looked into extensively for such studies, especially focusing on this, keeping India also into mind. Actually, I think one of the things that you have to do is one, keeping India focused, and keeping India in a particular group and analyzing Indian situation vis-a-vis the countries which are relevant for India to compare and things like that. So that's the other thing actually. So you may have to add more variables into the system, such as, let's say, the level of development of the equity markets, the market capitalization in each of these countries, actually. So, and then the FI participation in these markets, actually, that means, the funds are flowing across the border, actually. It's not only, so those kind of, variables could have strengthened your R square, would have better explained what you wanted to analyze as a relationship between the dependent and the independent variables, actually. That's it. Otherwise,
I have one final question. Whether these two systems should be competitive or whether they should not be. Like your results actually said that they are supplementing each other in developed economies. But when I look at it from an investor efficiency perspective, the investors are efficient only if they efficiently shift from one to the other, depending upon information, data, yields, etc. So should they be competitive or should they be non-competitive, the financial markets and the you were trying to say that in developed economies, they supplement each other. Right. So what should the situation be? Right. So I was just thinking.
Madam, but if we take the developed market experience, I would say that co-evolve and coexist in complement.
Yeah.
That's how I would look at it. Because that's how it has, helped the US economy to develop.
If one investment asset class is giving me less returns, it makes more sense as an investor for me to move to the one that's giving me something better.
So the banking system. So, for example, I don't know what will be its implications in India.
Anyway, that's for us to think. I don't want to take away a lot of your time.
I'm here for all the discussion.
It's just a question to think.
We can have a discussion.
I'm not looking for an answer.
So we have a few, sorry, sir. We have a few questions from the online audience. The first question is, traditionally it is accepted that the cost of equity is higher than the cost of debt. In such a case, why do reputed firms raise money directly from public?
Why do banks raise, why do firms...
Companies raise directly from public?
Right. I think there is no time bound to return it.
So if it is with respect to India, it's very low.
Yeah, it is very low for sure. Yeah. So I think that is one thing which I can think of immediately. So
how does capital raise moral hazard issue?
Yeah, I think I mentioned that part in the last slide. Once, because it has a negative relationship and it is aligned with the findings of RP paper. So which crowds out as capital growth. Because banks, as it is in the first question, it is mentioned that cost of equity is high. So once the bank raises funds from the equity, their cost of funds goes up. So to reduce that, they also goes at least reduce the deposits so that they can actually balance it out. So that's it.
And again, it always makes sense diverse source of diverse source. One cannot even with respect to cost, one cannot diverse. Fundamental in any finance in economics.
Thank you so much. Thank you.
For the next paper, For the next paper, we have Sampath Thokala, and his paper is on volatility spillovers on Indian commodity markets, empirical evidence from the MGARCH model.
Okay. You can ask him.
Yeah.
Hi, Mr. Sampath, can you hear us, Mr. Sampath? You can go ahead, share your screen, unmute and speak. Yeah.
Hello. Yes.
Yes, we can hear you.
Okay, sir. Sir, it is shown my PPT.
No, your file explorer we can see, not the PPT. I think you're ready to open the file. Can you click on the PPT or PowerPoint application below? You've opened the file, but it is there down. Can you click the PowerPoint?
Yeah, PowerPoint.
Below.
Near the Zoom mic.
Near the Zoom icon that you have. Local machine.
Whether is he comfortable or whether he has some difficulty?
This taskbar is our system.
It is our system.
Sir, can you stop your sharing your screen and you share again? And while sharing, just select the entire screen, sir. I think you have shared only the window.
Better than it's better.
Okay, sir.
Very good.
Yeah, tell me, sir.
Second, click on the share screen and select
Yeah,
the entire
share screen. Yeah, screen.
select the screen.
Select the entire screen.
Okay.
And then click the PowerPoint.
Okay.
Did you?
Yes, sir. Is it visible, sir?
No.
Actually, we have your PPT, sir.
Can we just show it from here? You can just look at it and
So when the screen is visible, like PPT must also be visible. It is open.
in this system it is open, but it's
Yeah.
Yeah.
Sampath, the alternative is we will play your PPT, right? And
Okay, madam. Yes,
you
madam.
can just say next slide.
I'll present.
Relax, just instruct and say next slide and then just go on. Yeah.
Yes, madam.
Yeah, that's nice. Yeah, this is visible to us. Is the slide visible to you, Sampath?
Yes, madam. Yes, madam. I'm visible, madam. Yes.
Wonderful.
Yes,
Go on.
yes.
please go ahead.
Yeah. Very good morning to one and all. I respected chair, Dr. Shunmugam sir, and discussant, Dr. Narsimhulu Siddula, and participant. Very good morning to all. Yeah, this is Sampath. I would like to present my presentation on the volatility spillovers in Indian commodity markets, empirical evidence from the MGARCH model. So actually, this paper is part of my PhD thesis, one of my objective of my PhD thesis. So where I am working in University of Hyderabad under the supervision of Professor Devash Acharya sir, in Professor of University of Hyderabad. And mostly the study has taken the spill of Indian commodity markets, especially have taken only agri commodities. How these commodities are the agricultural market volatility is a The commodities are considered from the investment point of view distinct assets in the domain of all asset groups. Commodity markets are known to be unpredictable. So this have got information in one of publication of authors. The study of the spillover in agriculture spot volatility and future prices help to analyze how data from one market influence the mechanism of volatility in another market. The next one. Next slide, please. Next slide. Next. Yeah, please stop. So agricultural market volatility is largely attributed to the fluctuations of agricultural products, that is volumes and values are always volatile. The volatility is typically a significant supply risk factor for agricultural commodities. The indicator of randomness in the price of an asset is volatility. The dynamic volatility phenomena is linked to market relationships, long-term and short-term price discovery and volatility spillovers. The next one. So spillover of volatility implies the returns of volatility often has an influence on the other markets' volatility returns. So the news of whether good or poor still impacts uncertainty, and if there is some relationship between the two markets, this effect is always channeled to another market. So the financial markets such as stock market or commodity market, the currency market, etc., are extremely volatile because they are continuously affected by financial, economic, and other factors. The next one. So here you can see the core problem of the analysis was to examine the Indian markets frequently traded on spot and future market in terms of framework for volatility spillover. So in the India's push to pursue an agricultural commodity sector is attributed to its strong output and demand position in the global economy. So inherently, chaotic, non-stated, and leptocratic and agricultural market data are also challenging to capture the consumer behavior. The next one. So today, market data are markets in the world that resulting in increased volatility. So most of the policymakers or portfolio managers are academics and other stakeholders, but it becomes a debatable subject for concern for any potential stakeholder as this extends to other economic sectors as well as other global economies. The next one. So the next one. This is my review of literature. Only I have taken just only couple of only the studies to show in my PPT. But in my paper, I have reviewed around 50 to 40 papers I reviewed, and those review of literature, the volatility spillover, how it's affected in spot and future, and some of the papers I have reviewed in price discovery mechanism, and the remaining papers. So within the Indian context, I have taken the whole agri sector in the review of literature, but the energy and other precious metals also have reviewed. But in my presentation, only just only 2 or 3 reviews I have mentioned here. The next one, only 1 to 3 reviews I have added here. The next one, just you go to data. Yeah, next one. Yes, yeah, please. So this is my data. So the studies released on secondary data such as closing spot and future prices and obtained daily basis from reputable sources such as the MCX and NCDX. So the study has used a sample of total 5 commodities which are most highly traded on the leading commodity exchanges, that is MCX and NCDX. The commodities selected as jeera, barley, wheat, and methyl and crude palm oil. The data is collected for all commodities from the 1st December of 2010 to 31st May of 2019. So these 5 commodities were chosen for the study because they are the most common traded commodities on the MCX and NCDX, both in terms of value and volume of trading. See here, MCX I have taken only the crude oil and methyl, and the jeera and barley and wheat I have taken from the NCDX. Because the agriculture, why I have taken this agriculture commodities because the NC takes the highest trading of all the agri commodities in the spot and future prices. The next time present, the next one is the methodology part. Yes. So I have taken this methodology. The study examines the volatility spillover effect from spot to future prices and future prices to spot prices of agriculture commodities, employing vector autoregressive model 1, the BEKK, Baba, Angel, Craft and Kroner model I have taken to run the VAR model. So we have selected log length through AKK information criteria, that is AIC. The detail. So this is the information. And this is multivariate generalized autoregressive conditional heteroscale model we have taken in multivariate models, because in the review literature and it passed the previous existing studies, they have taken only the GARCH model and ARCH model. So only the few papers that they have considered for the MGARCH model to know the spillover effect from spot prices to future prices of these commodities, the jeera or barley and wheat and crude oil and methyl, how it is the spillover one commodity, one price to other, that spot price to future price within the respective commodities. The next one, yeah, please. So this is in the VAR BEKK model, we have taken that one is conditional mean model and other one is a conditional volatility model. So these two methodologies we have seen this, the volatility spillover to know the spot prices and future prices. To run BEKK model, we run vector autoregressive model for mean equation. So as all our variables are stationary at level, which has been popularized by Sims in 1980 and revised with financial data by Hamilton in 1994. So present the study applies the VAR 1 model to estimate the mean of the returns. The log order for VAR has been selected by the SIC criteria. So the model has specified the one of this methodology has specified one model, that is RT equal to lambda 0 plus lambda 1 RT minus 1, the lambda 1 RT minus 2, the ET or expected T. So this is one conditional mean model which I have used in my paper. The next one. So then
Sampath,
oh, sorry.
Sorry to
Yes,
disturb you. Can you jump onto the findings? So we found
yes, sir.
the model is very robust, so there is nothing to ask about or understand.
Okay, sir. Yes, sir. Yes, sir.
Yeah.
So this is my next results. This is one more model, the conditional volatility model. The next one. So these are the arch and GARCH effect. And yes, next. This is my result, sir, which I have taken this the VAR BEKK model. So it's showing this the barley, the crude palm oil, and the wheat. These three, and in one more table we have two things are there, sir. The next one. Next slide, please. Yeah, this is my results which I have gone through this the model, the VAR GARCH model. Yeah, next one. Next. Yeah, this diagram takes for standard residuals, which the MGARCH BEKK, the junk box Q20, these are results, and MC Leo 20. These are my results I got, which have run these models. The next one. Yeah. Yes. So these are my conclusions, sir, which I have found in my paper. So return and the paper looked at the return and volatility spillover in agricultural commodities spot and futures, barley, mentha oil, jeera, crude palm and wheat, the agricultural commodities. So which has proven by several researchers to be MGARCH model for measuring the volatility and return spillover between spot and future was used in the study to test both volatility return spillover between spot and futures. So return and volatility spillover occurs between spot and futures of the commodities under consideration according to our findings. The next slide, this will show my findings. So however, all 5 commodities studied the extent of such the spot and future. This means that commodity future market determine the commodity spot returns and volatility. So prices for agricultural commodities in India have been quite volatile. Not only are agricultural commodity prices affected by demand-supply scenario, but they are also affected by seasonality, weather conditions, government intervention through export-import restrictions, levying of duties, and setting the minimum support price mechanism. The next one. So the due to alteration in the underlying supply and demand product prices fluctuate constantly throughout the year. Usually, market prices for agricultural commodities rise before harvest and fall after harvest, triggering fluctuations in volatility. So, understanding uncertainty helps farmers control their production risk and make effective marketing decisions. This also allows farmers during times of greater uncertainty to minimize their market exposure in creating an efficient buffer against adverse market fluctuations. Volatility analysis may also be helpful. In the next one. So these studies may also help market investors in the proper segment and management for their investment portfolio. Usually, agricultural commodities display high volatility intervals resulting from both positive and negative shocks of new knowledge. Market participants adapt as quickly as possible to the uncertainty generated by the new knowledge and seek to be benefit from such inefficiency. The empirical findings of this paper show that market participants, whether they are farmers or investors, are better prepared for changes in market momentum and the management of their market decisions by adequately evaluating volatility of farm commodities. So the same findings, almost finding there are the authors Musnur and Yuen, Alaris, and the 2013 also they have taken the same findings in their papers, but I quoted this. So this my study also. The next slide. So to achieve an effective price discovery mechanism, policymakers need to ensure stability in the markets. In addition, future markets need to represent all the information available while at the same time setting the future prices. The next slide. So this study makes the following recommendation for regulators, traders based on the aforementioned analysis and conclusions. The futures markets are riskier than spot markets due to these aspects of futures pricing. When confronted with this circumstance, we recommend that Indian policymakers refrain from modifying existing regulations or introducing new ones relating to agricultural commodity markets in order to keep them stable. Traders should restrict speculating in futures market, particularly those with higher risk, and utilize futures as a risk hedging tool. The next slide. So given the strong lead power of some commodity futures prices, important to manage the risk of sharp price fluctuations and lower risk. To lower the share of private investors and hence reduce dramatic price swings caused by excessive speculation, the tripartite cooperation between the government, business, and farmers should be increased. Regulators and traders should pay one more attention to price concern when a commodity is about to be harvested or is affected by optimistic news and policy. So this is particularly critical for futures variants with a long-term volatility. Then last one, the next one. So in the agricultural commodity futures market is mostly for farmers seek to reduce price risk associated with their products. Farmers are forced to distress sell their products in the market by market intermediaries, putting them at a risk of catalyzation. And the second one is the seasonality, participant knowledge, market size, and regulatory oversight are all contributing to the agriculture derivative markets to troubles. So this research took a multifaceted strategy to investors and hedgers. Investors may find that insights on market dynamics to be beneficial in marketing decisions. So regulators must look at an issue connected to market inefficiencies and take action to enhance this area. The next one. So this is limitation and future research. Future research should verify the generalization suggested study by incorporating other commodities and historical periods, and then as well as the utilizing advanced methodologies. So the present study only taken the 5 commodities, but in future maybe other studies also they can take some more commodities in agri commodities. They can use somewhat robust technologies to get the more robust results and more acquiring the information. It may helpful to policymakers or investors or producers or farmers. Yeah, thank you very much for giving this opportunity to presenting my paper in this the Westphal Institute in NISM and SEBI. Thank you, one and all.
Thank you, Mr. Sampath. We have our discussant, Dr. Narsimhulu, who will have his presentation.
Sir.
Yeah.
Yeah, very good morning to all. Yeah, first of all, I congratulate the Sampath to take the initiative to study the volatility spillover in Indian commodities markets. Okay. Yeah, first of all, with respect to the title of the paper, since you have taken only 5 agricultural commodities, the appropriate title could be the study of volatility spillover in the Indian agriculture commodities markets, rather the commodities markets.
Even you could have said select commodity.
Yeah, select. Since you have taken the representation of 5 commodities, and the research gap and motivation for the study, especially, there is, while reviewing the reviews, which you have incorporated almost, it runs together almost 10 to 12 pages of the reviews, which you have shared almost 50 reviews that you have done. I found actually all the studies with respect to similar studies on the volatility spillover, which have done extensively, both at developed markets front as well as the Indian context. Like even this is Manunga and Mishra paper that you have quoted in your review of literature, which is published in 2020. And one more that Raut, which you mentioned in your review of literature. These are the prominent papers with respect to the volatility spillover in Indian agriculture commodities extent. After reviewing the paper, I could not get there is no clear research gap has been found. Okay, and I don't know actually if how your study is different from the other studies. So please clearly mention what is your research gap, especially there are a number of studies already there in volatility spillover in agriculture commodities market, especially in India and developed market. Then you need to differentiate your study from the others, and your results would be anyway. That actually, since you said actually your study should be it should be value addition to the existing knowledge or the novelty. So that you please take into account. And one more, the motivation for this study. You said this is about inherently chaotic and non-stated and leptocratic agriculture commodities, agriculture market data are also challenging to capture consumer behavior. In this analysis, market activity has been studied and uncertainty spillover consequences related to potential exchange have been examined. This is a statement which was stated in your motivation for this study. I don't know, just you please validate the statement. Is it from the earlier studies that you have taken into account? Please justify in your motivation for this study. And also data recency, the sample selection that you have taken until December 2010 to May 2019. Even if you take into account COVID made so much volatility spillover from especially commodities and even equities markets in particular, especially in India. So you may find different perspective if you include this the data from 2000. If you extend the data from 2019 till 2021 December even, that could be the appropriate. So your result would be somewhere prominent with respect to that. And what is the rationale for selecting that study? Actually, that period. Is there any reason behind that you need to keep in mind, or else you need to isolate the extreme events from the study, or if you include, you may get different perspectives. the volatility spillover, whether it is there, especially in the events, whether more volatility spillover is there in agriculture markets rather in equities market. That you can extend your studying the volatility spillover between equity and commodities markets. Okay.
Sure, sir. Yes, sir. Yes. I'll
Yeah, one more, the sample size. You have taken 5 or 4?
5, sir.
5, yeah. 5 commodities wrong. I mentioned only 4. Actually, it is a 5 commodities that you have taken.
Yes, sir.
What is the sample selection criteria? Is it because if you take into account in Indian agriculture commodities market, more actually the volume of trading is from MGARCH. If you take into account NCDX as well as the Chena. Okay. So what is the rationality behind choosing only those 5 commodities? Is it you need to take into account, is it the fundamental factors that you take into account, or just you justify your sample selection criteria? And the validity of results and inference terms, especially surprised actually. You mentioned actually out of review your paper, out of 5 commodities, where 4 commodities, especially wheat, barley, jeera, and crude palm oil, where the spot leading the futures volatility, whereas mentha oil, where you got the results of futures leading the spot volatility, but the inference that you have, or the conclusion which you have drawn, it is quite we can say contradictory. Yeah, please take into account those things.
Okay. I'll check it, sir.
Yeah, and one more, the conclusions of this study. However, in all commodities, 5 commodities studied, the extent of such spillover is greater from futures to spot. That is what I mentioned here. Okay, this means that commodity futures market determines the commodity spot return volatility. Just you validate your results, findings with your inference that you have drawn. That is validation of research findings and conclusions of the study.
Okay.
And one more recommendations of the study that you have stated in the recommendation part. We recommend that Indian policymakers refrain from modifying existing regulations and introducing new ones relating to agriculture commodities market in order to keep them stable. Actually, as you know, the recommendations that should be come from your findings. And what actually, please justify these recommendations from your paper. Okay, and even you mentioned the policy implications with respect to especially the seasonality, as you said, seasonality, government intervention, and with respect to even MSP, minimum support price, and even and export and import restrictions, especially in the commodities market. Recently, the government banned even the wheat, especially with respect to the high inflation in the post actually COVID second wave, during the second wave. So seasonality and participants, the knowledge, market size, and regulatory oversight all are contributing to the agriculture derivatives market struggle. I don't know actually what made you to make this policy implications from your study. Please justify this in your paper. If you want to take into account the even the policy events in your study, you bring in and do validate your recommendations and policy implications. And also this research took multi-phase strategy to investors and hedgers. Please justify this also. And the scope for further research, that especially I told you, even there is an event like introduction of commodity transaction tax.
Yes, sir.
Especially in the commodities market, where you have that good event, especially with respect to the commodity transaction cost, where you can study the volatility spillover. That is more volatility from spot to future or future to spot because of the introduction of this CPT you can study, and the COVID also. These are my observations.
Yeah. Thank you. Thank you very much, sir. And I'll take it at account and I'll improve my paper, sir, based on your comments and suggestions, sir.
Any question?
Yeah. If you want to go,
No, please.
I have 2 things. In this paper, Mr. Sampath, you said at 2 different points. You said some government measures must be required, but what measures that you have not specified? It was generalized. Secondly, also at one point in time, you said some action from government intervention is required, but what particular action do you intend? So you should not be generalized. Whenever any research scholar or any person for that matter, we are we want to suggest something. We have to be very clear, how it comes up from our study itself.
Yes,
we have to be very specific. These are the only two small observations I thought that will help him.
Thank you.
Just sometimes it could be one needs to learn the language of this article. Yeah.
So Sampath, finally, let me conclude with my viewpoints actually. One is Dr. Narsimhulu had been pretty diplomatic in saying what he wanted to say actually, but I would want to put it right away that despite all the research that we do, government keeps on banning commodities, and then commodities come back into the futures market. And you know what the kind of effort and money and resources that it takes for the exchanges to develop these commodities. It takes a lot of time. So just for example, look at one commodity which got banned in 1 year, and look at the development of volumes in that particular commodity in the next 5 to 6 years. Almost it takes around 6-7 years to come back to the level where it got banned actually. So the point is, we need to be pretty precise in demanding what we want to demand, and that's where what Sarah had said and what Dr. Narsimhulu had said, that you need to connect what you are finding to what your recommendation is. So that is where our research tends to be very weak, and we don't guide the policy making. So if you want to guide the policy making, you need to connect it, the findings to what your policy recommendation is actually. And the other one is the information flow. You talked about the unidirectional. It will be unidirectional, but are there any bidirectional information flow between these two markets? Is also something, maybe you found out, you missed on indicating it. If it is bidirectional, I don't mind one kind of an unidirectional happening in one market. That's fine, actually. So ideally, as a researcher, we should look for bidirectional rather than unidirectional. And unidirectional in any of the direction is not, not good. That's how I would say that actually. I think, as Dr. Narsimhulu said, the period you should extend it to the latest period. That's all. That's all. Thank you. Thank you, Sampath.
Thank you. Thank you, sir.
Okay, so we'll move on to. Thank you, Sampath. We'll move on to the next. Thank you.
Thank you, sir. Thank you.
The next paper is titled "Do Mutual Funds Reward Downside Risk? Evidence from an Emerging Economy," and will be presented by Dr. Pankaj K. Agarwal from IIM Jammu and Dr. H.K. Pradhan from XLRI.
I think you are muted, Mr. Dr.
Yes,
Pankaj.
sir. Yeah. Yes, sir. Very good morning, Shunmugam Saab, Narsimhulu Saab, esteemed people present in the conference, esteemed delegates, organizers. I, Professor Pankaj, along with my co-author, Dr. H.K. Pradhan, I'll be presenting my paper today. I thank you in advance for the opportunity given. I'll just share my screen. So the title of the paper is "Do Mutual Funds Reward Downside Risk? Evidence from India." So the motivation of this study came from a phenomenon which we are all witness to. This is my organization. We have been seeing increasing retail participation in the equity markets, either direct investing or in case of mutual fund investing too. For example, the growth of AUM in mutual fund has been phenomenal. We all know that right now. Latest data for January 2022 suggests it is.
Dr. Pankaj,
yes,
sorry to stop you. Can you make it full screen?
Yeah, sure, sir. Sure, sir. Yeah. So we know that the AUMs of mutual funds have risen like anything, and till January 2022, they stood at 38.89 lakh crores, and alongside the growth in AUM, the retail participation has also been growing. In fact, I would refrain from saying retail, it's individual participation. So if you look at the AMFI data, it suggests that right now approximately 55% of the AUM is held by the individual investors. A similar trend is witnessed in the equities market too. I was wondering that whether this increasing participation of individual investors, does it call for some examination which was hitherto undone in the mutual fund industry? So we find that in the mutual fund space, a lot of research has taken place. A simple Google search leads to 1.8 million plus results on mutual fund research. But when we look at the retail investor side of mutual fund research, we do not find any. So this was the first primary trigger. Secondly, when we started thinking about the topic, we felt that 2008 financial crisis has led to a fundamental shift of focus from return to risk in the entire financial sector. And especially within the risk also, the risk is now classified as downside risk also. So we felt that because retail or individual investors are not that financially sophisticated, that's a stylized fact. And the industry was also trying to portray the mutual funds as a product of choice for retail investors. Retail investors are buying that and they are increasingly getting into this space. So won't it be worthwhile to see whether the downside risks that mutual fund investors, especially the individual investors, are going to assume, are they being sufficiently rewarded by this product, mutual fund, which is being portrayed as a product of choice for individual investors in line with the developed countries. So essentially, these two were our triggers for this study. So we decided to study the relationship between downside risk and how it predicts the forward returns in the mutual fund industry, because individual investors who are exposed to those kind of downside risks, are they getting sufficient compensation for that? So we could have studied risk as a whole also, but risk as a whole has asymmetry, especially because asset classes returns have been found to be asymmetric. And so because of that, we decided to focus exclusively on the downside risk. So when we looked at the literature, we found that there has been an old hypothesis by Kahneman, which refers to loss aversion, which suggests that people dislike losses more than they like gains. And because of that, we have seen established research for a long time now in the equities market space, which suggests that equities with higher downside risk potential are the investors demand a risk premium. So risk premium for the overall risk and additional risk premium for the tail risk or the additional downside risk that the investors are taking. But to our surprise, we did not find any literature in the mutual fund space which talks about this relationship. Although in the hedge fund space, we did come across some literature which we have reviewed. And we saw that, especially in the developed countries, people, especially Bali in 2007, which I have discussed in detail in the paper, have studied the relationship between downside risk and hedge fund performance. And there are some other studies after Bali studying the same phenomenon, but none in the mutual fund space, and particularly in India. So we felt that this could be our research question, that whether downside risk is rewarded suitably by the mutual funds. But then when we studied more literature, we found that there could be some other strands which can be connected. And our research questions, we finally boiled down to these. First, obviously, I've discussed. Then second, how mutual fund managers respond to high downside risk and thereby achieve high forward returns. Is there any cross-sectional variation in fund returns related to downside risk? That is what we wanted to study. And then are there any proxies for downside risk that we can find out? For example, downside risk will not be computed by the individual investor. So are there any proxies which they can look at and conclude that maybe, this is the kind of risk they're going to assume? So age, fund style, size, etc. All these factors we have taken into account in studying this relationship. And finally, there was a recent study in 2019 by Bodnurak, which studied a very interesting idea called downside risk timing. So we are all aware of the mutual fund timing, where fund managers are supposed to alter the composition of their portfolio in anticipation of an expected market movement. But what Bodnurak suggested is whether they are able to alter the risk per se, that is downside risk per se, in anticipation of market movement. So for example, if markets are expected to rise, so are they getting out of low beta or low downside beta stocks, to be precise, and getting into high downside beta stocks so that they can get benefited from the increasing market direction. And in case of an expected market downfall, are they moving into low downside beta stocks and exiting out of the high downside beta stocks? So they named it downside risk timing, and this was a very recent study. We felt that this gives us an opportunity to complement our existing research questions with the ability of the fund manager to manage risk in the mutual fund. So these were our research questions. Our study has some of the first for the Indian markets. One, our study happens to be another study. I mean, previous study was done by us only, which has used survivorship-free database in mutual fund research. Secondly, ours is the first study in Indian mutual fund markets which has utilized the holdings data. So for VAR downside risk related measurements, we have used return series, and to complement our study and make it more rigorous, we have used a research measure based on the holdings of the mutual fund portfolios. So that is another first with this study. And the framework that we have employed, we have employed a very rigorous framework to interpret significance of our results, especially taking into account the heteroscedasticity and autocorrelation present. We have utilized the New West T statistic. That is another thing that we have done to ensure the robustness of our results. And another thing that we have done is we have used pivotal statistics to identify significance. I think I'm not a statistician, but I decided on that because I found that pivotal statistics are more reliable and they are prone to less variation in comparison to direct measurements. So this is how our study is different from the existing mutual fund researchers in India. So the methodology that we have employed is we've used a sample of open-ended diversified equity schemes with a growth option in India. So there were 128 schemes. Since we had taken care of the survivorship bias, we looked at all the schemes that existed during this period. 2018, because we did not want to include the COVID period. So just before that, we ended the data period. The data was taken from the Accord FinTech ACE-MF database. Out of 128 schemes that existed, around 12 schemes did not have a sufficiently long return history. They had a return history of less than 2 years. So we dropped them and we were left with 116 schemes. And for measurement of downside risk, we zeroed in on the Cornish-Fisher expansion of value at risk because it takes care of the presence of skewness and kurtosis in the return distribution. So we felt that this could be a better measure for measurement of downside risk. So we have used two methods. One, we have created VAR sorted portfolios across our study period and tried to connect the value at risk, average value of risk of the sorted portfolios with the 1 month forward return of those sorted portfolios. So this was the first sort we employed. We also went on to do bivariate sorts. So we did bivariate sorts based on age and VAR, then size and VAR, and then style and VAR. So these were the bivariate sorts we employed. The sorting mechanism was similar to Pharma and Macbeth, famous 1972, and later on employed by Bali 2007. So this is how we created the sorts. So our first examination was based on sorted portfolios. In order to find out the aggregate results, we also tried to run a panel fixed effects regression. We took the same independent variables, that is value at risk, Cornish-Fisher value at risk, age, size, and then the style. But this time we used a panel fixed effects regression. For computation of downside risk timing, we, as I referred, that Wadmurak paper was the trigger for it. We decided to give another test to their model in on Indian data. And we use what they call active change in relative beta, which is a holding based measure. It finds out that how much downside beta has been changed over a period. So this is the equation, and we try to regress the 1 month forward return of the previous month's active change in relative beta. So our findings have, this was our summary statistic. You can see that 70% plus funds in our sample had presence of non-normality. So I think this justifies our use of the Cornish-Fisher expansion of VAR. Okay, now when we look at our first sort based on VAR, simple VAR and Cornish-Fisher VAR, you can see on the table that there appears to be a monotonic relationship when we go on from low VAR portfolios to high VAR portfolios. We see that returns of those portfolios are monotonically increasing. Now, a couple of things to be noticed here. One, the highest risk portfolio, the return has dropped a bit. I think this finding is also similar to the international findings in hedge fund space, but largely the general trend is that return monotonically increase as the value at risk increases. Now, this is forward return. That is what makes it more interesting. Now, the difference between monthly return of high value at risk portfolio and low value at risk portfolio was 0.37%, which translate into 4.8% approximately annually. Now, this is definitely economically a very significant amount of return in Indian markets, where we have had in last 10 or 15 years, approximately 10 to 11% of Nifty returns per annum. So this 4.8% extra. So, I mean, if we can do a long shot on the low VAR and high VAR, we can get a riskless 4.8%. At least this is what this finding suggests. Now, one point of concern was that though we were using very rigorous New and West T-stat and standard T-stat also, we were not finding the statistical significance. That is the problem with the Indian mutual fund research. Because the kind of fund history that we have only 116 schemes and the data was for around 9 years. And this has led to our not being able to get statistical significance in many cases. That is a problem with the kind of data that we have. And unfortunately, we could not have used daily data because it did not work. I tried that, but it was not working. Okay, now the second univariate sort was on age and size. Here we can see something very interesting. One is that the relationship is not monotonic. When we reach the median age, then the fund returns increase as the age increases. But beyond the median age, we see that the fund returns tend to decrease as age rises. The same is the trend in case of size also. Okay, now when we did bivariate sorts on age and VAR, we found that again the relationship was found to be significant for both high age and median age group. In both the cases, we found that the value at risk was predicting 1 month forward returns. But in case of low age group, we found that relationship turned out to be negative. One possible cause could be the low age funds are the newer funds, and in their hurry or desperation to establish themselves, they might have taken on a higher value at risk, and that might not have really worked for them. So that might have backfired. This could be one possible explanation for this finding in case of a low age group. When we did it on size, we saw that in case of size also, there was a monotonically increasing relationship between across all sizes, that is high size, medium size, and low size. In all types of funds, we found that VAR was able to predict the future returns 1 month ahead. When we did the bivariate sorts on style and VAR, now this was very interesting because our search for statistical significance ended here. In the large and mid-cap style category, we found that this relationship was very, very highly statistically significant, whereas in other cases, the relationship was not so obvious. In the case of mid-caps, the relationship was actually negative. I think during the study period, the mid-caps had seen their fortunes going up and then going down very fast. So perhaps this could be the reason that we found a negative relationship in the mid-cap style funds. But the relationship was similar for large and mid-cap, large cap, multi-cap, and small cap, with statistical significance found at large and mid-cap. These findings were corroborated with the panel fixed effects regression also. There also we saw that when VAR is used in isolation, it predicts the 1 month forward return. But in case of the Cornish-Fisher VAR, we did not find the statistical significance. When we studied age and size, there was expected sign of relationship. Increasing age leads to lower returns and increasing size leads to lower return. Both were statistically significant. Now the interesting part comes when we start combining the variables. So when we combine the Cornish-Fisher VAR with age, So the Cornish-Fisher does explain the return, but the statistical significance is very weak. However, when we combine the Cornish-Fisher var with the size, then the size comes across as a stronger predictor of forward returns than the Cornish-Fisher var. And this was something which we found across all models that we have employed. We've employed around 10 models, which I just showed on the slide. These were the 10 models that we have employed. So in all models, size came out as a very strong predictor of the forward returns in case of mutual funds. So our quest for a proxy variable can be answered with the results that we have obtained, that size happens to be perhaps the next important variable in addition to value at risk in predicting the forward returns. The final question that we had was whether Indian mutual fund managers are engaging in risk timing. So I think when we talked to a couple of industry professionals, we found that 2008 crisis has brought back the focus on risk, and fund houses were trying to institutionalize their fund management strategies so that fund managers were more constrained to stick to that strategy, and their focus had shifted from being perfectly right to not being wrong. So we felt that this focus of fund managers shifting towards risk perhaps might give us some interesting insights on their risk management ability represented by the risk timing measure. Now here we found mixed results. We found that for 1 month horizon and 6 month horizon, the median fund manager was exhibiting the downside risk timing ability. Just to reiterate what we define as risk timing is the ability to get into low downside beta stocks in anticipation of a market fall, and ability to get into high downside beta stocks in anticipation of a market rise. So this ability was found at 1 month and 6 month horizon going forward, but for 3 month and 12 month, this ability did not exhibit itself. So now we were wondering how could this be? I mean, 1 month and 6 month, the presence of ability should also imply presence of it at other horizons. So we could not really find a reason why this might be happening. And so this does not lead us to any conclusive findings. So we felt that either the fund managers had failed in their risk timing attempts, or they did not possess the risk timing ability in a conclusive sense. So this is what we concluded from this result. So what is the summary of our results? So we found that the international evidence in equities can be extended to mutual funds also, and there does exist a relationship between high downside risk and higher returns going forward. And the finding appears to be consistent across various sizes, styles, and ages. Especially in the large and mid-cap style, in our data period, this conclusion was this result was found to be statistically very significant. We also found that in case of fund managers' ability to time the risk, we find mixed results, and this perhaps also indicates the dichotomy between the ability to take risk and manage risk and the culture of chasing returns at the fund houses. Perhaps more data will lead to better insights on this. So we feel that the implications of this result is very high, especially because the retail investing is on the rise in both mutual funds as well as equities market. So the equity investors can use these findings, and this corroborates the claim of the mutual fund industry as a whole that they are the product of right choice for the retail investors too. However, perhaps the fund houses could have a look at the risk management practices at the fund houses, and they can maybe think of the incentive structures which are largely biased towards achievement of returns rather than risk-adjusted returns. So generally, they do quintile-based performance appraisal at 6 months or 1 year, where risk takes a backseat and its ability to beat returns for the peers that seems to be ruling the day. So this was our paper, and yes, the paper definitely has some limitations. We could have perhaps included the COVID period also, which we plan to do so, because there also the downside risk was brought back into sharp focus, although due to different reasons. So that's all from my side.
Thank you, Dr. Pankaj. It was a unique paper that I could agree with you that, and a robust paper, no doubt about it, actually. So one of the things that my colleague, Dr. Narsimhulu, will have his, analysis, which will be discussed with you. Before he starts his discussion, I just had a few comments. Maybe I would say that to strengthen your this one.
Sure.
Maybe in terms of the investing style, you should have looked into in terms of active versus passive investing. The funds which do active investing versus the passive investing, which could have differentiated the results, which could have thrown back some more insights. Number one. Number two is you could have expanded the base into not only equity funds, but also hybrid funds, which are focused on equity, not on others. Basically, because you wanted to look into equity versus equity focused, this one. So because there are funds which are focused on derivatives, but at the same time, there are limitations as to what they can do with derivatives, actually. So maybe, this could have thrown some policy implications that regulation should allow higher participation in derivative markets, and so thereby the fund manager could have managed the fund from any untoward downside risk in the markets, actually. So that's another comment that I thought I would put it to you, which could further strengthen the paper. So
thanks a lot. Thanks a lot, sir.
Thank you, Doctor.
Thank you, sir. Thank you, sir, Pankaj sir, and Mr. Pradhan sir. Actually, to take up this a unique paper in the Indian context. And these are my views, and it is well written and nicely and organized and very structurally organized, and analyzed the research methodology in terms of and the results also as per the defined variables that we have taken. These are review of literature. Since already you mentioned, okay, you restricted your data till 2018, and further you may take up this and the COVID impact also, which actually more prominent for rewarding the downside risk of the mutual fund. Okay, fund managers especially. That would be another area you can take up for extension of this study.
Sure, sir.
And research gap, it is well defined. And this is, you said, actually, this is one of the prominent, actually, this is the first initiative which you have taken from the Indian context. This I could find some of the papers which are recently published. You may take into account these papers and you may integrate your results with these papers. If you find, okay, that do fund managers time implied tail risk.
Yeah.
This evidence from Chinese mutual funds, which was published in 2021. And one more, this investor sentiment and the pricing of macro risk for hedge funds. Because you may take into account, or it may take up for your further study to take into account the COVID impact also. These are my the latest research papers which I found in this area. And sample selection is too appropriate. Out of the 158 mutual fund schemes, you have taken 116 open-ended with a growth option. And data recency did not comment, already you defined. Okay. Then research material is well defined, especially you have taken where with the expansion of this published feature expansion, which actually measures the downside risk. And also where based portfolio sorting you have done in terms of the age, size and style with fixed effects, panel data, and both sorting univariate and bivariate sorting, and the downside risk timing ability also you have tested. And these are my since you have even the downside risk, especially global financial crisis that you have started with, but you can study the downside risk comparison between global financial crisis and pandemic. These are the two extreme events. One is the financial crisis event. This is a natural event. Even you can take up this in a different perspectives, whether the risk reward is more in the natural event or the manipulative event. Basically, that you may think of to extend your study. These are my observations. Thank you, sir.
Thanks a lot, sir. I think they are very, very valuable. And Professor Shunmugam, sir, and Professor Narsimhulu, sir, both of you, I'm really thankful for your time and attention that you gave to this paper. And I'm sure with your comments incorporated, this paper will improve itself. Thanks a lot.
I'm HK Pradhan. Can I come in for a minute?
Yes, sir. Yes, sir.
Okay.
Yes, sir. Please.
I'm Dr. Shunmugam and Dr. Srivastava. Thank you so much. It was lovely to see Pankaj and our paper getting presented. Unfortunately, I couldn't visit. It would have been lovely to see you. But I'm really thankful to both of you for excellent comments. I think, Pankaj has rightly said, we took care of as much possible to see that methodologically we are right. Or at least near, we tried. And I think your point is good that the other type of fund, the balanced fund, the thematic fund, all of this could have a little bit brought in other idiosyncratic factors to the model. So we thought that, so what happened at the end of it, our sample size became smaller. But we tried our best to take care of the survivorship bias, to take care of the all other fund characteristics, even the measure of value at risk. I think Pankaj probably didn't spell it out. We did take care of the normal, the VAR or other kind of VAR, but we found that some kind of adjustment to skewness, I think it works better. The Cornish-Fisher version. And one other thing, see, the finding is extremely important. I mean, you see, if the fund managers are not concerned about risk, I think that itself is an important finding for a large number of funds. And I think you probably take investors for a ride. And with a large number of retail investors coming in, and as you know, I myself having worked in the mutual fund industry in some way or other, and I think that's really so. And so often, I don't know whether Pankaj calls it a luck or something else, but this is what it is. But we tried, but we really take your excellent point, and we have a sample bias, small sample size. But unfortunately, this is all the India is about. I mean, we couldn't get a larger number of funds as possible. So this and also we didn't want to mix up with many other countries and get an evidence which is more more probably country. So we thought let's have a country-specific evidence. So I think thank you for the opportunity, and I personally felt better to speak to you. Couldn't visit your conference. Thank you, sir.
Thank you, sir. We ideally wanted to have you in person. Actually, with your presence, it would have enhanced, the kind of discussion that we had. So my suggestion to Dr. Pankaj was basically more from the perspective of bringing in some regulatory recommendation and what needs to be done. Is the policy, is the fund manager being restricted by the regulations actually? So which is, I think, you having worked closely with the industry, you can put in, more this one through Dr. Pankaj's research. So that was, one. And two is like, downside risks. When he talked about immediately, then I talked about he actually differentiate, the style of investing in terms of active versus passive. So that he can look into what kind of habits which are existing in active. Active, there is nothing to explore, in passive. In active, we can still find out, what kind of behaviors are existing in terms of the fund manager's style of investing and things like that, actually. So,
thank you. Yeah. No, yeah. Thank you. In fact, I think one of the conclusion for the regulator would be, see, you have a riskometer which is too generic. And it really doesn't capture the downside risk. Riskometer is a generic risk. And so every fund reports it's a kind of thing that is like you have reported, the NAV uploaded, riskometer reported, so all are done. But I think, we need to also see whether downside risk is also captured. So maybe, I don't know, this is where the research could contribute more working.
Yes, sir. So maybe a new measure to say the downside risks or something.
Absolutely.
Okay. Anyone? Thanks a lot, sir. I think no more comments, and it was our pleasure to review your paper.
Yes.
Thank you, Dr. Pankaj. Thank you.
Thank you, sir. Thanks a lot.
Thank you.
Thanks, everyone.
Thank you so much, Dr. Shunmugam and Dr. Siddula, for being with us today. I'd like to request our jury member, Dr. Jinesh Panchali, to kindly present the conclusion to me. Dr. Narsimhulu.